this podcast episode, we will look at the balance sheet in a little more detail. A balance sheet must always have a company name. In this case, Uluru Exporters Pty Ltd. A balance sheet must also have a date and must use the phrase balance sheet as at, followed by this date. The first assets on a balance sheet are called current assets. These are short-term assets that can be quickly converted into cash if the business needs cash. They are also called liquid assets. The most liquid asset of all is cash itself. In this example, Uluru has cash on hand of $10,000. Other current assets include stock, which the business would hope to sell quickly, and accounts receivable or debtors. Accounts receivable is quickly turned into cash because debtors pay within 30 days, or they can be factored at a discount to a finance company. The total current or short-term assets for this business are $70,000. The next group of assets are called non-current assets. They cannot easily be converted into cash, and they are held for the long term to improve the productivity and profitability of the business. They are also called fixed assets. Examples include buildings, equipment, and vehicles. In our example, Uluru Exporters have total non-current assets of $890,000. Other businesses may have more non-current assets, such as land, machinery, fixtures and fittings, etc. The final category of assets are intangible assets. These are non-physical assets that cannot be seen, touched, or physically measured. These are assets because the business has built up a reputation over time, and this reputation is worth money if the business were ever to be sold. Examples include brand names, patents, trademarks, and goodwill. In our example, Uluru has $30,000 worth of goodwill on its balance sheet. This gives Uluru total assets of $990,000. This means that everything that Uluru owns is worth $990,000. The next podcast episode will concentrate on the other side of the balance sheet, that is the liabilities and owner's equity side.